Hello everyone, and welcome to this webinar that we are hosting on IFRS 17 for investors. My name is Fred Nieto, and I'm the Head of Investor Engagement at the ISB, and I'm joined today by our board member, Steve Cooper, and we have organized a presentation for you on IFRS 17 that tries to look at things from the perspective of the outputs so that investors can begin to grasp the big picture around this new standard and the effects that it will have on financial statements once it begins being implemented in the year 2021. So we've organized this webinar, and our intention is to have it be fairly interactive. So I will be monitoring the Q&A queue, and I'm happy to interrupt Steve as we go along and we make our way through the presentation, so that we can address questions at what we think is the most opportune time, given the content that we're delivering. So with that, I'll hand it over now to Steve, and we'll get started with the webinar.
Okay, thanks, Fred. So I would encourage you all to submit your questions as Fred suggested, and we'll do our best to answer those as we go along. So we've got some slides to go through, and as Fred said, it's primarily focused on the outputs. We're going to initially talk about the reason why the board has undertaken this project to modify insurance contract accounting, but predominantly we're going to focus on the numbers that you will see. So IFRS 17 was issued just a few weeks ago. It's the culmination of a very long project from the IASB to replace IFRS 4, which was always intended to be an interim standard. It permits many different accounting practices in respect of insurance contracts, and I think most people accept that it really isn't up to scratch in terms of providing relevant information for investors. The new standard is some way off in terms of its application, so it's effective in 2021. So the first time you will see real numbers is going to be in early 2021, either Q1 or half 1 2021. And whilst early application is permitted, we certainly do recognize that this is quite a significant undertaking for many insurance companies to adopt the standard, and that's one of the reasons why we permitted this 3.5 years of transition. But if some companies are able to early apply and wish to do so, then that is also permitted. It also includes the restatement of comparative information. So as I said, we're going to talk about why we've developed it, how it works, what it means for you as investors. There will also be some supplementary slides on some of the more detailed aspects, but I wasn't going to go through those in any detail within this presentation. Also, in the presentation itself, there is some sort of explanations of the jargon and the changes in jargon and key metrics that will arise under IFRS 17, but I wasn't going to go through the detail of those. So the prime focus is on how IFRS 17 works and how it changes the numbers that you will see. So let's talk briefly about why we've developed IFRS 17. The problem at the moment is that much of the information that's presented to investors about insurance contracts, we believe, lacks relevance and transparency. That's not to say that there are problems with all companies reporting, because some of it is good and it is highly relevant, but that's not always the case. And it's partly this sort of variation in the insurance accounting which is the problem, but the lack of useful information that is obtained in some cases. So, for example, the use of old or outdated assumptions, not updating assumptions related to future cash flows, not updating discount rates, using more of a cost-based approach. We think that provides less relevant information. Not reflecting options and guarantees fully in the measurement of insurance contract liabilities. This is perhaps less of an issue in Canada, but it is very much an issue in some jurisdictions. Also using an expected return on assets as a discount rate. We'll talk more about the detail of the discount rate determination later, but in some cases at the moment, companies are using a discount rate including an expected return, and also using that in circumstances where perhaps it's inappropriate because of the lack of linkage with those underlying assets in the insurance contract liabilities. But I'll come back to that in a second. The other problem is a lack of transparency about profitability itself, and particularly having profit recognized at different points in time for an insurance contract. In some cases, there is an element of upfront profit taking. In other cases, profit is recognized late in the period of an insurance contract based more on a bonus declaration, cash earnings type approach. So the different profit recognition for different types of contracts makes comparability a challenge. Also, you can even, as a result of that, and as a result of the sort of the lack of sort of rigor within IFRS 4, you often see non-GAAP measures being employed at the moment. I mean, in some jurisdictions, non-GAAP measures based around embedded value reporting or some of the regulatory reporting requirements. So we think lack of sort of reflection of the economics of the business is a key issue. We also recognize a lack of comparability as another issue at the moment. Comparability within jurisdictions, comparability across jurisdictions, and also comparability with other industries where there's a very different approach, for example, to recognition of revenue. And IFRS 4 essentially allows the continuation of many of the local accounting practices that were present prior to the adoption of IFRS, and that lack of comparability will be resolved by IFRS 17, providing for the first time a globally consistent accounting methodology. Okay, so introduction as to why we've done the project. Let's go on and start to talk about some numbers. Now, I'm going to start off with a typical existing income statement, and before we move on to what's going to be seen under IFRS 17. And this is really just to try and illustrate some of the challenges which are present at the moment. The existing income statement might be fine for specialist investors, but many of the non-specialist investors do find this a particular challenge. And I'd like to really just point out one line in here which I think sort of illustrates the challenges which are present at the moment, and that's the one towards the bottom where it says change in insurance contract liabilities. And this line item incorporates several different components. It's partly a variance, it's partly an accretion, it's partly changes in discount rate assumptions, and it's partly a reconciliation of the gross premium top line, which is essentially a cash flow, to an accruals figure in the bottom line. And because it combines several different components, it's a particularly difficult number to understand and particularly to forecast. One of the features of IFRS 17 is that this line item entirely disappears. Effectively, what's happening is that the 9308 in this example is being split into different components, and those components are being reported in a much more logical way. So that's sort of an illustration of some of the challenges which are faced at the moment. And there are similar challenges in the balance sheet. In the balance sheet, you will often find several different line items related to insurance contracts. So unearned premium reserve, claims reserves, policy loans, premiums receivable, deferred acquisition costs, and I've illustrated some of those in here, but by no means all of the items that could appear in an existing balance sheet. The new IFRS 17 balance sheet is going to simplify this significantly, and a lot of this sort of detailed information is going to be organized in a much more logical way within the notes. All right, end of introduction as to why we've done it and some of the challenges in interpreting the existing financial statements. Let's move on to IFRS 17 itself. So this is the new income statement, and there are a couple of things which I'd like to emphasize in here. The first is that we've incorporated in the new model what you might call a source of earnings analysis. So can you see the two sections in this being the insurance service result and the net financial result? This is not something you will typically find at the moment under IFRS accounting. It's something you could get under embedded value reporting, but not in the IFRS 4 financial statements. The insurance service result is the underwriting result. It's the profit or loss arising from the provision of insurance services, insurance coverage. The net financial result separates out the investment income and the accretion and finance expense related to the liabilities. By separating out that insurance finance expense, at the moment it tends to be incorporated within the change in insurance liability line. It enables us to provide this net financial result and show clearly the two sources of earnings it will typically find in an insurer, the underwriting result and then the result from the investment income minus the financings. Second thing to notice about this is that the format of the statement will be the same whatever the insurance contract. So whether it's long-term, short-term, par, non-par, long-tail, short-tail, it's the same income statement. Now, of course, the numbers will differ, and for example, for short-term, non-par, short-tail business, pretty much the whole of the profit is going to be in the insurance service result, and the net financial result will be unimportant and a small number. If this was more of a long-term par savings type business, perhaps universal life, or maybe it was an annuity type business where the spread is much more important, then you will tend to find the net financial result will be much bigger. So the numbers will vary and the source of earnings will be very different for different types of contracts, but the format of the P&L is going to be the same. Another thing I'd like to point out is the reinsurance. Can you see how reinsurance is dealt with separately from the insurance contracts themselves? IFRS 17 applies to insurance contracts issued by an entity. They could be issued by an insurer, they could be issued by a reinsurer, so insurance contracts issued, IFRS 17 applies to those. But IFRS 17 also applies to reinsurance contracts purchased. So insurance contracts purchased by an insurer to offset some of the risks in its underlying insurance contracts. We keep those two elements separate, so the gains and losses from reinsurance shown separately from the profit before the reinsurance. In this particular case, I've shown it as a single line item, gain or loss from reinsurance. In practice, that could well be split into the different components on the face of the income statement. If it isn't, it has to be split into the different components in the note. So this would include, for example, like the ceded premiums and the other items that would make up that net gain or loss from reinsurance. And then the last thing I'd like to point out in the income statement is the top line insurance revenue. At the moment, one of the problems is that the top line for insurance companies isn't really consistent with the whole notion of income and expense measured on an accruals basis. Many companies present the top line as a cash flow, essentially premiums received. And that approach is completely inconsistent with any other industry. Nobody in other industries would show as a cash flow a line item in the income statement. Also, showing a cash inflow for insurance companies as revenue would mean that you would include deposit components within revenue. It would be like saying in a bank, deposits made by customers are revenue and repayments of deposits to customers is an expense. We don't do that in banking. It's clearly a balance sheet transaction. And therefore, in insurance, we think the same should apply. So insurance revenue will now be only the consideration received for services provided and won't be a cash flow itself. The mere fact of changing to an accruals basis for revenue, that also simplifies things enormously because it also means that we get rid of this change in insurance contract liability line because that was necessary when you have the top line as being a cash flow. So overall, we think this is a more consistent approach. It's going to be more understandable. It's going to provide you with better, more relevant information, particularly the source of earnings analysis. I'm going to go on in a second to explain where these numbers come from and what lies behind them and what sort of additional information that you're going to get out of the model, because certainly the information about performance in IFRS 17 doesn't just stop with the income statement. It goes well beyond that, because there's a whole host of information that's going to be presented in the notes, which also will help you understand and evaluate insurance company performance. Before we do that, though, let me turn to the balance sheet. The balance sheet is going to be a lot simpler under IFRS 17 because essentially it is going to be one number. Insurance contract liabilities shown as a single line item on the face of the balance sheet. It's possible that insurance contracts could be in an asset position. It's not that common, but it's possible. If they were in an asset position, then you would show them on the asset side. I haven't bothered showing that here. Insurance contract liability is the obligation the insurer has to the policyholders to pay them cash, to pay claims, return account balances, and also to provide services, the coverage services. There is an analysis of that number into its different components, but we present that in the notes. And we present it in a way that I think is more informative than is done at the moment, because we can put it in the context of the changes in the liability and what's sort of causing those changes from one period to the next. You'll see that in a second in the form of a roll forward. Reinsurance contracts are also kept separate in the balance sheet, as you can see. So reinsurance contracts that have been purchased will tend to be in an asset position. It'll be a receivable from the reinsurer. Reinsurance contract assets are then shown separately. Now I'm going to concentrate in the next few slides on the insurance contract liabilities. However, pretty much everything I say also applies to insurance contract assets, so reinsurance contract assets, except, of course, it's all reversed. So it's assets instead of liabilities, expenses instead of income. But the level of detail that I'm going to show you about insurance contract liability disclosures essentially is repeated for the reinsurance contract assets, even though I haven't shown the notes in the presentation. Okay, now the key to understanding IFRS 17 is to understand how we measure insurance contract liabilities. And if any of you have been following at all what the ISB has been doing over the last 10 years or so, you probably would have heard of the so-called building block approach. And, well, the three building blocks that are referred to in that are on the screen now. We don't actually use the phrase building block approach in the final standard. We just talk about the insurance liability measurement model. But as you can see, the liability in the balance sheet is made up of three components. It's the present value of future cash flows. You might know that more as the best estimate liability, to use existing jargon. The risk adjustment and unearned profit. We call the unearned profit contractual service margin in the standard, but that's what it is. It's the unearned profit in respect of this contract. Now, people often say that we're using a fair value approach for insurance. That's not quite true. We certainly do have a current value for two of these components. So the PV of future cash flows, the best estimate liability, is an up-to-date measure of the expected cash payments that will be necessary to fulfill this contract. So the claims, expenses, account balance payments to policyholders in the future. We also add on to that a current estimate of risk, so a risk adjustment that reflecting the current assessment of the insurance risk that is being covered. Now, I'll say a bit more about that in a second. But in addition, we also have what we call unearned profit. Now, this is not fully a current value measure. That's because it depends upon the past. If I issued a contract 10 years ago, which is still outstanding, but for which I charged a high premium, I would have a high unearned profit. If I happen to charge a low premium, there would be a low unearned profit. So the unearned profit reflects how profitable that contract was considering the premiums that were originally charged. So in that sense, it's not a full current value. It's not sort of assessing what a market participant would require to take on the liability, which would be more of a fair value type approach. I'll explain a bit more about each of these three components in a second, and then we'll do a bit more analysis on the numbers. So firstly, the future cash flow. So best estimate liability is the present value of future cash flows. So we need the cash flows and we need the discount rate. The future cash flows have to be current. They need to be up-to-date estimates, so they're adjusted every period. They are probability weighted and unbiased, so it reflects the probability of lapse or claims happening. They need to be unbiased in the sense that there is no premium in here for prudence or conservatism. So if it was a normal distribution, the best estimate liability has to be the 50th percentile. Now, this is not always the case at the moment because many best estimate liabilities will incorporate an element of conservatism. I'm not saying that risk is absent from the model because, as you saw on the previous slide, there is a separate risk adjustment. So insurance risk is incorporated in the liability measure, but it's incorporated in an explicit way, not in a manner that's sort of difficult for you to identify. So you have a best estimate liability at the 50th percentile, and then a risk premium that takes you up to, well, whatever percentile it is for your reserving. I'll explain about the risk adjustment in a second. Some of the cash flows can be complex. So if you have guarantees, options that are embedded in these contracts, then the cash flows themselves can be complex, and that would then require more complex modeling. So stochastic modeling or risk-neutral valuations, whatever is necessary to get to the objective, which is a probability-weighted, unbiased set of cash flows. Notice that the cash flows include acquisition costs in the diagram below. The acquisition costs included in there mean that we don't have a separate DAC asset. There is no deferred acquisition cost asset in the model. It means that the acquisition costs are rolled into the liability and the CSM, the unearned profit calculations themselves. Now there's more to this, and I'm not going to go through some of the detail that's in the standard. So for example, one of the features of the standard is discussing what we call contract boundary. And this is all about when a future premium is a cash flow for an existing contract and when a future premium actually represents a future new contract. And this distinction between those two will have an effect on the accounting. So there's quite a lot of detail in the standard that I'm kind of glossing over here, but it's not really necessary to understand the model itself. It would be necessary if you were preparing the numbers and you had to determine, for example, exactly what cash flows you're incorporating in the measurement of the liability. You need to know the contract boundary. So once one's got cash flows, the next thing to do is to discount them. And the discounting of the cash flows has to be at a current rate, so it's updated every period, unlike in some accounting at the moment. And it has to be market consistent. So you need to make full use of all available market data that's relevant in estimating the discount rate for the liability. Now, the discount rates will have to be estimated. So in particular, when the liability cash flow duration extends beyond the observable market yield curve, then you will need to estimate what those rates are. So in Canada, the observable yield curve might go out 20 years, maybe it's 25 years, I can't recall. But certainly Canadian insurers will have liabilities where the cash flows will go out beyond that period. We require the insurers to estimate what they think is a market-consistent discount rate beyond the 20 or 25-year time horizon. Now, some investors have said, well, doesn't this introduce an element of subjectivity in the model, and how comparable are the numbers going to be really? And yes, it does. It's a principles-based standard, and it does introduce the potential for a lack of comparability. However, we would say that it's no different from accounting in many other industries. If you're following a company with a large pension liability, exactly the same problem arises. You have to forecast cash flows and find an appropriate discount rate. If you're a financial institution with unquoted assets, maybe equity investments which are not quoted, private equity investments, well, they have to be valued. So you end up with level 3 valuations for those assets. So there's always an element of subjectivity in accounting, and insurance is no different. There will, of course, be extensive disclosures about the cash flows, but also disclosures about the discount rates, including a full yield curve for the liability cash flow discount rate. Now, one of the important things on the discount rate side is under what circumstances you are allowed to use an asset return as a discount rate. In most cases, we say that you should not discount at an asset-based return because liability cash flows are not linked to those assets. However, if the liability cash flows are linked to underlying assets, for example, it's a participating type policy, then we would say that it is appropriate to include a risk premium on the assets in that discount rate. So we have a much clearer basis for insurers to determine the correct discount rate, whether it's a risk-free type return or whether it's a return that includes an asset return premium, and it's based upon the characteristics of the cash flows of the liability themselves. This is quite different in some jurisdictions because you will often find at the moment circumstances where liability cash flows which are not linked to underlying assets are discounted at an expected asset return. And that is inconsistent with the accounting that we have all the way through the rest of IFRS. We think it doesn't reflect the underlying economics. So a significant change for some will be moving to a situation where companies will have to remove the asset return premium from the discount rate for discounting, for example, annuity contracts where the liability cash flows are not dependent upon underlying assets. The next slide just expands on this slightly, because if you have a liability that is not dependent upon underlying assets, so a non-par liability, the discount rate that we specify doesn't include any asset return premium. However, it should take into account the liquidity characteristics of the liability. So it's actually not government bond risk-free that's used as the discount rate, but it's what we call an illiquid risk-free rate. And we permit in the standard two ways of determining that, either a top-down approach where you start off with the asset yield, the yield on your portfolio of bonds that you hold, or the yield on a reference portfolio of bonds. In this case, we've said, let's assume it's 4%. From that, you would remove the expected credit losses and the risk premium associated with credit losses. So this is the 1.5 in the diagram. Take it down to 1.5%. Or we say you can also do a bottom-up approach and have an explicit adjustment for the liquidity characteristics of the insurance contracts themselves. Most insurance contracts are illiquid, and therefore the perfect hedging asset is an illiquid risk-free asset, and that's really what this is trying to get to. The general principle is that you discount at a rate that reflects the characteristics of the liability. That's really what this whole thing is about. And taking into account the liquidity characteristics and then the linkage to the underlying assets is key to determining that correct discount rate. So we have cash flows, have a liability discount rate. Combining those, we end up with a best estimate liability, or the PV of the expected cash flows. The next component in the building block approach, if I can use that term, is the risk adjustment. So this is where we take the liability measure to be more than the 50th percentile, and we have an explicit adjustment for the risk to the insurer of bearing this insurance risk. We say it is the compensation that the insurer requires for bearing insurance risk. Hence, it is entity specific. Now, this also will mean that risk adjustments are not necessarily comparable one company to another. One company might take the best estimate liability at the 50th percentile and maybe increase it to the 65th percentile. Another company might increase it only to the 60th percentile, because each company requires a different compensation for bearing insurance risk. So it's not a market view. It's not what a market participant would require. It's what the company is charging. We don't think that's a problem, because really what this risk adjustment does is split the total unearned profit from a contract into two components, a risk component and then a service component. And all it does is change the timing of the profit recognition slightly, because one of those components is run off on the basis of release from risk, and the other one is run off on the basis of service provided. We initially started the project having a sort of a more comparable approach based around a market participant view, but that came under a lot of opposition. So we've ended up with this more entity-specific approach to adjusting for risk. But as I say, it's part of the total unearned profit from the contract, and you'll see in a second when I show the roll forward how that then affects the profit and loss statement and the underwriting profit earned in the period. Okay, so the last part of our three building blocks is the unearned profit. We call it the contractual service margin. So maybe if I use a simple example, it'll make it clear what this unearned profit is. Let's suppose I issue an insurance contract and there's a single premium paid at inception of 100. The probability weighted expected claims to the policyholders is, let's say, an outflow of 80. This is on a PV basis as well. Maybe the risk adjustment is, say, 5, the premium for risk. Well, in that case, the unearned profit is just the balancing figure. It's 15. So I receive a premium of 100. I expect to pay cash of 80. I have unearned profit in total of 20, 5 of which is compensation for bearing insurance risk, and 15 is the compensation for providing the services in the first place, the service margin. Under IFRS 17, you don't recognize that 15 as a day one gain. And the reason is that the board does not believe that any services being provided on day one. Services are provided over the period of the contract in the form of insurance coverage. So, I mean, if, for example, you were to buy a new mobile phone contract and take on a 2-year mobile phone contract, the mobile phone company does not book on day one all of the profit they expect to earn from you over the next 2 years. Instead, the mobile phone company recognizes profit as they provide you with call and data services. So we think the same thing should apply to insurance, where only as you provide the service of insurance coverage, do you recognize the profit. Now, a number of companies are particularly upset about this, because a number of companies at the moment do book day one profits on some of their contracts, and it's fair to say that IFRS 17 has been particularly controversial, and this is one of the controversial areas, the recognition or the lack of recognition of day one profit. Now, as you can see in this diagram, whilst the value of new business, the 15 in my example, is the unearned profit on day one, that then gets adjusted over time. So as you can see, there's accretion of the CSM. You then change the CSM because estimates change. And it's only as you provide services that you recognize in profit and loss the gain and make it from an unearned profit into an earned profit. And then you carry forward in the balance sheet the remaining unearned profit at the end of the period. Now, I'll show you this in numbers now, just to illustrate that rather better. So we've got the liability measurement. On the balance sheet, we have the insurance contract liability. It's made up of the best estimate liability, risk adjustment, and CSM. So let's now move into the data that you're going to see in the notes to the accounts. And this is really where a lot of the useful information is going to be, and this is what we're going to spend the rest of our time on in this webcast. So this is a note. You will find in here, firstly, an analysis of the insurance liability into the three components we've just been talking about. But also you will see a reconciliation of the opening to closing position. The changes in the liability arise essentially from two causes. One is that gains and losses are reflected in profit and loss, and the first two sections in here, where we get insurance service result and insurance finance expense, show items which are changes in liability that are reflected in P&L. And then also there's cash flows, so cash in and cash out will also affect the liability. Now I'm simplifying this calculation slightly because I'm ignoring things like business combinations, portfolio transfers, foreign currency translation differences, so I know that this is a slightly simplified version. Also, in order to fit it on one slide, I've made this a very sort of summarized version of the roll forward, and on the following slides I'm going to expand what I've numbered in here 1 to 5 to show you the detail that will actually be presented in the notes to the account. So this is certainly not the level of detail that you will see in practice, because, for example, under the heading of future service yet to be provided, there are a number of components to this that you will see. So let's look at these four components for future service yet to be provided. The first one is new profitable contracts recognized. When an entity issues new contracts, it needs to assess for those contracts what the future expected cash flows are, the premiums and the claims and expenses, what it thinks its total risk adjustment needs to be, and then, as I said before, the balancing figure becomes the contractual service margin. You can see in this case there's a 0 in the liability column. That's because there is no amount that's reported in profit and loss for new profitable contracts which are issued. So the 2344 indicates the fact that it's negative, indicates that this is a net cash inflow from these new contracts. The sign convention used in this table is that liabilities are positive, so a negative number indicates an asset position. So these contracts that have been issued have a present value of premium income 2344 greater than the present value of the claims and expenses. So it's profitable contracts. After adjusting for risk of 969, it leaves an unearned contractual service margin of 1375. 1375 is the present value of new business. 1375 plus 969 is the present value of the total profit that will be recognized in respect of this contract. The 2344 is actually itself split up in the standard, and there are disclosure of two components of this. You have to split it into the present value of new business premiums and the present value of claims and expenses. Having the present value of new business premiums means that you can get a new business margin for contracts which are written in the period. This new business margin, the 1375 divided by the present value of new business premiums, is something that you may get under embedded value reporting, but you certainly don't get it under IFRS 4 at the moment. So this is going to be a very important new piece of information that you will get from many of the companies that you follow. And I should note that you don't just get one of these tables, you will get several, because there is a requirement in the standard to present separate tables if there are significant differences between the insurance business written, so that providing an aggregation on one table would not be sufficient. So if, for example, an entity had a universal life business and a term and a coverage business, then we would expect those to be shown in separate tables in order to fulfill the disclosure requirements of the standard. So you will get this new business margin separately for the different business lines that the company has. The second line down is estimate changes. Now, obviously, the future cash flows and the risk adjustment, these are estimates, and over time they will change. So in this particular case, the 1452 being positive means that there's been an increase in estimated cash outflows for these contracts. And what that does is reduce the unearned profit. So you can see 1491 after adjusting for risk is the reduction in the unearned profit, the CSM. So whilst this particular company has issued a number of contracts and built up a higher unearned profit with the 1375, it's more than given that back again through the variances on its existing portfolio of contracts. But you'll notice there is no entry in the total column, hence there is no loss recognized in P&L. And that's because we believe that these estimate changes affect future profitability and therefore should be reported in future periods as an adjustment to the CSM that's amortized.
So we have our first question, and it's going back to the promise of detailed disclosure by, I guess, line of business or product. And the question is, will insurers have the same business line disclosures so that they can be compared?
Well, it's a principles-based approach. We could have specified, it's motor, and then it's health, and then it's this, and then it's that. But we don't do that in any other industry. So it's a principles-based approach that says disaggregate if there are significant different characteristics between the business that you write. Now, we give examples, and in fact, it's paragraph 96. Fred's just been pointing it out to me. Paragraph 96 says that you may have to consider types of contracts, for example, major product lines, geographical area, reportable segments as a basis for the disaggregation. I think it would be unrealistic for the IASB to specify exactly what that disaggregation would look like. And as I said, for example, in IFRS 15, revenue recognition, we also have a similar principles-based approach, and we don't specify exactly what the disaggregation should be. So, sorry to disappoint. I think perhaps you were hoping that there would be some sort of greater structure in that disaggregation. Okay, so those are the first two lines in this table. Now, you notice the next two lines refer to onerous contracts. Now, this was a particularly controversial part of setting the standard because sometimes an insurer is going to issue contracts which are not profitable. They are onerous and the PV of the expected cash outflows is greater than the PV of the inflows. And sometimes what were profitable contracts previously turn in to onerous contracts. And that's essentially what these two line items are doing. So onerous contracts at initial recognition, in this case a loss of 123, and contracts that were previously profitable turned into loss-making contracts, and that's essentially the 94. It's a little bit wider than that, but that's really what it is. Crucially, these two numbers depend on what we call the unit of aggregation, because how you measure these two line items all depends upon how you aggregate or disaggregate insurance contracts. What some in the insurance industry would have liked us to have done is to have considered portfolios as a whole and not split portfolios into profitable and unprofitable components. At the other end of the spectrum, we could look at contract by contract, and we could seek to identify individual contracts that were onerous. And of course, you will get a different answer in terms of the extent of onerous contracts in each case. We've ended up with an approach which is pretty granular. So you will see onerous lines of business that are written, and indeed you will see onerous contracts written in a particular period, even though in other periods contracts might have been profitable. So there's a fair bit of disaggregation. Now, this is something that we've certainly had a lot of positive reaction to in the many sort of in-person investor meetings that we've been doing over the last few weeks, because it seems that seeing when onerous business has been written or unprofitable business has been written is certainly something that investors seem to value.
So we have another question that links to, I think, the two line items that you've presented so far here on estimate changes. And it's asking about the fact that these estimate changes look like a reserve top-up, and if so, what was the board's rationale for not recognizing estimate changes related to future service in the current period's P&L?
Estimate changes can relate to two things. They can relate to future service, or they can relate to past service. Now, at the moment, we're just dealing with future service. And the rationale for this is that you make an estimate on day one, you then change the estimate on day two. Well, all that does is change the amount of future profit that you would expect to recognize. And the argument from many was, well, why should that be booked as a loss now? All it's doing is saying, well, a contract that we thought would have a certain level of profit now has a bit less profit. And wouldn't it be appropriate to then recognize that lower profit in future periods? The circumstance when an estimate change does produce an immediate loss is when it relates to past service, in other words, adjustment to claims which have already come in. And this will be in the third section that I'll come on to in just 1 second. It was a controversial area, and the approach that you've sort of implied here was actually proposed by the board in our first document that was issued. So we issued a discussion paper many years ago, and in fact this was the approach that was proposed in that discussion paper, and indeed I think in the first exposure draft. But after many hundreds of meetings and extensive consultation and comment letters, the board changed its approach and felt it was better to be more consistent with, for example, how we deal with these types of long-term contracts in other industries, which would be implicitly showing up the change in estimates as changes in future profit. Let's go on to the second section, shall we, in terms of P&L, and that is the current service. So as services are provided, so you earn profit, and all that happens here is you release the CSM and you release the risk adjustment. So as you can see, the CSM of 923 is released in the period. That's the amount of the previously unearned profit that's now being earned because we've provided coverage. The fact that 923 is roughly 1/10 of the CSM balance indicates that these are roughly 10-year contracts. The calculation is a bit more sophisticated than that, though, because it takes into account when profit arose and the different cohorts that profit applies to. So it's a more sophisticated calculation so that we can try and ensure that the 923 does relate to the services provided in the period. Now you'll also notice here that we have an experience loss. Now this is where claims in the period are higher than or lower than previously expected. So in this example, we've got claims which are being paid that exceed the previous estimate by 35, and that is booked as an immediate loss, and that's because it relates to current services being provided. Changes in estimates relating to future service adjust future profit. Changes in estimates relating to current service or past service are shown immediately in P&L. And on the following slide, you can see the same thing, but adjustments to past claims. So claims have come in previous periods. We're now truing up those claims to actually what we pay. So in this case, there's an extra amount of 40. So now you can see the three components that make up the insurance service result. The amount that's reported in P&L, it is the onerous contracts, which is the 217, the service provided in the period, the 1492, together with the experience adjustment, and then the adjustments in respect of past claims, so the catch-up adjustments for those. And that then creates the service result that appears in profit and loss. That's not the only item in profit and loss, because we've got in our source of earnings analysis then the financial result. Now in this particular case, the financial result is very big, and this must indicate that this is a life business with long-term liabilities, and that's indeed what it is. This insurance finance expense is made up of two components. There is the unwinding of the discount, and then there's the changes in discount rate and other financial assumptions themselves. So in this case, the liability goes up by 7391 in respect of the fact that we're moving through time and PVs get bigger. But also it's gone up by 1917, which is a change in discount rate. So in this case, discount rates must have come down in the period, therefore increasing the liability by this amount. Now this is where the standard allows a choice. We don't normally like offering choices in accounting standards. We know it's bad practice from your point of view. It makes things more complicated. We get a lack of comparability. But I'm afraid this was a choice that we had to do in order to get this standard issued. There are certain jurisdictions in the world who are very comfortable with having financial assumption changes in profit and loss. Australia, Denmark, Belgium, some examples of those jurisdictions where companies there seem to be more comfortable with having all of these assumption changes and the finance expense in profit and loss. But then there are other jurisdictions which are much more nervous about the volatility that comes from putting discount rate change effects in P&L. So this would be South Korea, Japan, Germany, France. In order to get a global standard issued, there was no way that we could require one or other of these two treatments. And in the end, we've allowed a choice. Now, it's not great standard setting, it's not great from your perspective, but it's a limited sort of effect on the overall model because the disclosures that we're presenting will enable you to reconcile one to the other. So it's, as I say, it's not great standard setting, but it's what we needed to do in order to get the sort of prize of a global standard on insurance contracts and hence greater comparability. What we're likely to see, though, is consistency within jurisdictions. And I know the Australian regulator has already said that they would not expect any insurance companies in Australia to use the OCI option. So you may find that in sort of particular jurisdictions, one or other practice will tend to prevail, or indeed that the regulator will step in and constrain it themselves. So that's the financial effect. In the P&L, that's offset against the investment income. IFRS 17 doesn't deal with the investment income side of the equation. The assets in the balance sheet are regulated under IFRS 9, a different accounting standard. And then lastly, the cash flows. So the cash flows are the final component in the reconciliation of opening to closing balances. And this is where we see the premiums received in the period. That 33,570 at the moment in current accounting will tend to appear as the top line of the income statement. We don't think that cash received meets the definition of revenue as far as accruals-based accounting is concerned. But we recognize that premiums received are an important volume metric, and therefore we require this to be separately presented in this roll forward. So you will still get your gross premiums written using common jargon, but it will be in this roll forward. What appears in the profit and loss account is a revenue number which is much more consistent with how revenue is measured in other industries. Consideration received that applies to the services provided in the period. So then with the claims and expenses, as you pay those claims, so the liability falls, insurance acquisition cash flows as well. This then completes the reconciliation. A lot of useful information within the reconciliation, the new business, the variances, the separation of underwriting from financing, the cash flow information, the premiums written in the period, a lot of detailed statistics, and of course the disaggregation according to line of business or geography, whichever basis the company uses. And then the last part of explaining the model is to explain a little bit more detail about the service result. Now, I've just been explaining that the insured service result is made up of the CSM release, the risk adjustment release, the onerous contract adjustment, changes in estimates of incurred claims. But actually it's not presented like that in the income statement. In the income statement, we present insurance revenue less insurance expenses to get to this underwriting result, the service result. Now to do that, I need to split the total insurance contract liability into two different components. And this second split provides us with a second roll forward and a second sort of set of statistics in the analysis. The two roll forwards can be combined into one table, but it would require quite a large number of columns to do so. So we present it in the standard and all the sort of accompanying material we've published as two separate roll forwards. This second roll forward requires you to split the insurance liability into what we call a liability for remaining coverage and a liability for incurred claims. Now, this is essentially what you see in P&C accounting at the moment. We call the liability for remaining coverage, well, at the moment it's the unearned premium reserve, and the liability for incurred claims is the existing claims reserve. The difference is that this split into these two components is going to be required for all contracts in the future, not just P&C contracts. So one of the features of IFRS 17 is that the accounting does not follow the nature of the product. The accounting is the same across the whole product range. Now, there are some features of contracts that have to be incorporated in the accounting, and I'm not going to talk about the so-called variable fee approach today. That's an example where there's a particular feature in a participating contract which requires an extra adjustment to the CSM balance. Nor am I going to talk about the simplified approach, the premium allocation approach, which is applicable for certain short-term contracts. But these are modifications to what I'm talking about, not a fundamentally different approach. Let me explain what I mean by insurance revenue then. Insurance revenue is, essentially it's the premiums received adjusted for the time value of money, but then also adjusted to remove what we call deposits. Let me use my example that I had right at the beginning. So I issue an insurance contract, I take a single premium on day one of 100, I have best estimate liability 80, risk of 5 and CSM of 15. The 100 is reported as the liability on day 2. So day 1 of the premiums are received, day 2 the liability is 100. And we call that the liability for remaining coverage because I've got to provide coverage over the coverage period, and the obligation of 100 represents the obligation to pay cash, cover the risk, and then provide the services, the 80, the 5, and the 15. At the end of the 5 years, that 100 has to go to 0, because at the end of the coverage period, there is no liability for any further coverage. We may have what we call a claims reserve or a liability for incurred claims if during the 5 years claims have been received and they have not been settled by the end of the 5 years. The liability for remaining coverage, firstly, it's adjusted for time value of money, so the premium for 100 is received in advance, so we have to accrete that. But then it falls for 2 reasons. Firstly, it can fall because I repay money to policyholders in the form of a return of deposits. Now, this is where we pay cash to a policyholder, but the payment is unconnected with an insured event happening. So if, for example, I have a universal life type policy, a savings type policy, then if the policyholder cashes in, they get a repayment of their account balance, for example, then that we would call a return of deposit. However, if the insured event happens, death or whatever it is, then there'll be a payment because of that insured event, and that's not a return of deposit. So when there's returns of deposits, we don't recognize that reduction in the liability for remaining coverage as revenue. We simply treat it as a balance sheet transaction. The remainder of the liability for remaining coverage does then turn into revenue. For P&C businesses, the deposit component will be 0, almost certainly 0. Hence, the whole of the premium of 100 in my example turns into insurance revenue over the 5-year period. In fact, more than 100 because we adjust the 100 for the time value of money. But if we were dealing with a savings type contract, a universal life contract, for example, then part of the payments to the policyholders would constitute a return of account balance, return of deposits, and therefore the revenue reported in P&L could be considerably less than 100. One of the features of the new insurance standard is that the top line in the income statement reported by many life companies will be significantly lower than it is at the moment. At the moment, you will typically find that premiums received are booked as the top line in the income statement. They're booked as revenue. Now, it's only the premiums earned which will be booked as revenue, because deposits are going to be excluded. So this is a big change, and for some insurers, a significant reduction in the size of their income statement. Of course, it's offset by a reduction in expenses, because if you don't show the deposits which are received as income, then you don't also show the deposits which are repaid as expenses. And this is the reconciliation. So we have a column for liability for remaining coverage, ignore the onerous contract component for the moment, and then a column for the liability for incurred claims. And if in the left-hand column you can see a reduction in the liability for remaining coverage of 9856, which is the revenue earned, so that's the amount of the premiums which are applicable to services provided in the period. And then a little bit lower down, you'll see 6465, which is the repayment of investment component. So you can see these two elements. If this was a non-par P&C business, the 6465 would be 0, and the 9856 would be a bigger number. If this was a company offering predominantly savings components and the insurance element was relatively small, then of course that revenue line could be even lower than it is presented here. If you look to the right for the liability for incurred claims, you'll see a figure of 7985. These are the claims and expenses incurred in the period. The difference between that and the revenue is essentially the CSM that's recognized. So this provides you with a way of translating the recognition of CSM into revenue and expenses. Now, it's not quite the CSM, because you've also got to allow for the risk adjustment and experience gains and losses, but that's essentially what it is. So this second roll forward provides you with a way of tying in the changes in the liability to the income statement presentation of income and expenses. But it comes to the same ultimate answer of 1235, which is the insurance service result. Remember, everything that I'm doing here is before allowing for reinsurance. This is all gross. Every number I've shown you is gross. Reinsurance will be a separate note. And everything that I've said so far about insurance will also apply to reinsurance. So you will get another roll forward showing the reinsurance contract assets and all the movements in those as well. So as you can see, there's a lot of transparency that comes from this model. It's a consistent measurement approach, a measurement approach that we think provides with you with a relevant measure of the liability, taking into account all information about cash flows, discount rates, that it's updated each period, and that it combines with that the unearned profit arising from the insurance contracts in a way that presents meaningful performance metrics. But you get, in a sense, two views of performance. There's the current period performance through services provided in the period, but there's also performance which you can think of in terms of the value of new business written. So you get this sort of new business approach that you can use to get metrics like new business margin. You could do valuation multiples based upon new business profit, but also you get a measure of performance which reflects more the services provided. So you can do your normal sort of multiples type analysis and margin, combined ratio analysis. All the combined ratios will remain. So this is what we think of in terms of the ultimate benefits of the model that I've just been showing you. So global comparability, for the first time we're going to have comparability across insurers. Relevant measures of liabilities, financial risk and economic mismatches are revealed, so that net financial result will be a very interesting line for you to analyze. The source of earnings approach will also help your analysis. The embedded value type information, the value of new business, is integrated with the accruals accounting, so we have a consistent measurement basis for the two views of performance. Better disclosure, more transparency. Many of the existing KPIs will remain, so you'll still get your loss triangle, you'll still have your combined ratio, you'll still have the gross premiums written, many of the metrics which you currently use, but they will be more comparable as well, because they will be more consistently measured across different companies. And you'll get new KPIs. So insurance revenue will be available for the first time. The net financial result will be available for the first time. Now, some of you may be thinking, well, this all does sound rather complicated, and when you first see it, there is a lot to take in, I recognize that, but I'm convinced that you will actually find this to be a much more intuitive and understandable approach once you just work through the numbers. Particularly removing the different accounting for different products, I think will make the whole thing more understandable. So, that's how we think of the standard and the benefits that we think it's going to provide. Okay, Fred, any questions?
All right, thanks, Steve. So we have some time here for a Q&A. And the first question we have is asking for some comments on global comparability in the context of what the FASB is doing for U.S. GAAP on their insurance contracts.
Okay, well, when I say global, of course, I don't quite mean global. I mean global apart from the United States, because the United States will not be adopting IFRS 17. U.S. GAAP will remain. So although this started off as a joint project with the FASB, I'm afraid it didn't come to pass that we ended up with a converged standard. So I perhaps should add in this slide global apart from the United States comparability. There are two other jurisdictions in the world where IFRS 17 might not be applied. In Japan, there's a free choice between US GAAP, IFRS, and local Japanese GAAP. And in Switzerland, there's a free choice between US GAAP, IFRS, and Swiss GAAP. But apart from those jurisdictions, pretty much everybody else will be applying IFRS 17. IFRS 17 does have to go through an endorsement process in many of those jurisdictions, so it is subject to the local politicians approving the standard, which is the process all new IFRSs go through, for example, in Europe. Okay, any other questions?
So we encourage you to ask questions if you have any. We have a follow-up that we can share with you to the slides that are on the webinar software, which just relates to the issue of KPIs. So we have some information around what existing KPIs will look like and what new KPIs might look like, and a bit of a jargon buster as far as a scheme that helps you look at existing terminology and the terminology as it looks in IFRS 17.
And we'll be doing more of these education events in the future. Honestly, the new standard is a long way away. You're not going to see numbers from companies until at least 2020. So, we recognize that there'll be more for you to sort of get to grips with over the next 3 years. In particular, I've glossed over some aspects of the standard, as you obviously realize. So, contract boundary, exactly how is OCI calculated. I mentioned something called the variable fee approach. That's quite important if you're looking at companies with participating contracts. The simplified approach for short-term P&C contracts, where you'll actually get a bit less information that I've said in here. So there's a number of other areas that could be the subject of future educational events. But we were very keen that the investors should get an early look at this, and certainly the reaction from investors to the offer of these meetings and webcasts has been very strong. So clearly there's a lot of demand from investors to really understand what's going on in this field, because it is going to be a big change, more so in some jurisdictions than others. Some aspects of Canadian accounting are very similar to IFRS 17, and it's one of those jurisdictions where perhaps the change is not as great. If you're an analyst in South Korea, I'm afraid you're subject to enormous change because of the way in which they're currently measuring the liabilities. But the big benefit of IFRS 17 is this prize of global comparability and greater relevance
One of the materials investors have been very interested in, and it's on the implementation page for the standard, is the effects analysis report. And it has some miniature worked examples on products that look a lot like a variable annuity or a unit-linked style policy, and other worked examples that look very much like a fixed annuity style product. And many investors have found that to be very helpful as far as sinking their teeth in.
We do have a question about European endorsement. I'm sure many of you are aware that there's a pretty lengthy endorsement process that is applied in Europe. Probably over the next 2 years, the European Commission and its various constituent bodies will be scrutinizing IFRS 17 to decide whether to apply it in Europe. And it's perhaps the most bureaucratic process of any jurisdiction around the world in terms of IFRS adoption. And then this will create some uncertainty in the next 2 years, particularly in the European market, about whether IFRS 17 is going to be applied or not. The job of the ISB is done in terms of issuing the standard, but it's only one step in the process to the final use of the standard. And as I say, in Europe in particular, it has to go through this endorsement process. I can't comment on the outcome of that. Obviously, the European Commission is only just starting to go through that process now. But as the questioner sort of alluded to, it does create some uncertainty about whether the standard will be applied in Europe. I'm very hopeful. I mean, certainly the reaction we've got from the investors we've talked to so far, which is quite a large number now, isn't it, Fred? And
over 100 now. So.
And I cannot think of a single investor that's turned around and said, I don't want this. I mean, almost all of them have been enthusiastic about the comparability, the more greater relevance, the new data that's being presented. So if the reaction of investors is anything to go by, I think the standard will sail through. But I do know, we all know that some of the insurance industry themselves are quite hostile to this standard. So it's no secret that there are people that would certainly like the standard not to be endorsed, and you only have to read the press to identify who those people are.
One topic we included at the back of the slides that has featured in many of the meetings we've done with investors that might be worth spending some time on is the transition and just the concern that some investors have about preserving data points to do trend analysis and so on, and that's probably worth some time. Okay,
that's a good point. I think we're probably nearly time up now, but I'm sure we could fit in this slide because I see a number of you are still on the call, so that's good. So talk about first-time application of IFRS 17. Generally, when standards are applied for the first time, whenever there's a change in accounting policy, we require what's called full retrospective application. And this is kind of rebooting the whole system to show the balance sheet at transition as though the new standard had always been applied. So it's sort of resetting the liability onto an IFRS 17 basis at transition. The problem with insurance is that that is actually operationally very difficult. When insurance contracts have been issued, let's say 20 years ago, to apply retrospective application, you have to go back 20 years, work out what the CSM would have been 20 years ago, and then roll it forward by 20 years to get to the opening balance. And clearly, having to dig around in old records to sort of get this information would be very onerous. For that reason, we allow some simplifications, and we talked here about a modified retrospective approach or a fair value approach, which is effectively what you see currently in business combinations. The good thing is that it only affects one number out of all of the metrics that you will see. So for existing contracts, the best estimate liability, the PV of the future cash flows, and the risk adjustment are not affected by transition. They are what they are. And for new business written, it's all going to be under IFRS 17. So any contracts written after beginning of 2020. The problem is the transition unearned profit. And it's that number that is subject to some estimation, simplification, if you cannot do this full retrospective approach. But there are disclosures, so you can identify what's been done, and those disclosures continue in future periods. It's unfortunately sort of an inevitable consequence of trying to restart a new system on a new basis when you're dealing with such long-term contracts. And although it's an issue that we have to face in order to implement any change in accounting for insurance. If you're not willing to accept the possible lack of comparability on the transition on Unearned Profit, then you can't have IFRS 17. It's as simple as that. Okay, any other questions or things you think we should cover?
I think with that, we've probably covered the topics that have featured most commonly in the meetings we've done with investors since we published the standard. I think at this point we just thank all of the audience for joining us today on this webinar, and in particular thank our colleagues at the ACSB for inviting all of you to join us on this webinar, and we hope you found it helpful. And we'd like you to know that we're here to help, and we encourage you to get in touch with us.
Okay.